the Federal Reserve and indeed global authorities have something of a dilemma. They can either support the accumulation of further private sector debt and indeed public sector debt and generate positive GDP growth, or they have to accept higher levels of unemployment. So we're presently on a collision course with the latter option. And so that sense of fearing, foreboding is simply that where we are, monetary policy now will lead to, I think, quite a rapid decline in economic growth, arguably a global recession. And if that comes to bear, I think we'll be back into the analog which has haunted the global economy since 2008, which is one of tepid economic growth and an inflation which actually may fall stubbornly below the 2% target of central banks.
On today's episode of What the Finance podcast, I have the pleasure of welcoming back Hugh Hendry, who we interviewed just over a year ago. So Hugh's a very unique voice in the macroeconomics world. He's also known as asset capitalist, as we can see with his hat. So Hugh, thanks so much for coming on the podcast today.
A pleasure. I live the life of a gypsy in a tropical French island, and today I've just moved into another beautiful apartment. So a bit hot, but always welcome the opportunity to sit down and let's thrash things out.
Yeah, definitely, and I think you're making all of us very jealous with the, with the background. It's not a filter. It's hard to tell these days, but it's the real thing. But yeah, I guess in the recent interview a few weeks ago that you had with, I think her name is Julia LaRoche, which I really enjoyed and I really like her show. You said that you're quite fearful about what's happening in the markets. So, what are you currently seeing, I guess, with the data that's coming out in the US and other countries? And are you still fearful today?
I don't like the term fearful. I don't know what I was trying to describe there. I guess a sense of foreboding. Interest rates are now calibrated. American interest rates, which are largely determining global rates, are in the death zone. And we're beginning to see the encroachment of economic weakness, and we're beginning to see all the forward indicators of consumer prices falling. The rate of change is rapidly falling. And I believe that in America, inflation is going to be running with a 2 handle, and Federal Reserve rates are over 5. So we're plus 3%. And that makes it very hard to support debt. And economics today and yesterday and has always been somewhat simple. The principal coefficient for determining growth in today's modern economy is debt growth. There are 3 components: population growth, productivity growth, and debt growth. The other 2 are not contributing. And so the Federal Reserve and indeed global authorities have something of a dilemma. They can either support the accumulation of further private sector debt and indeed public sector debt and generate positive GDP growth, or they have to accept higher levels of unemployment. So we're presently on a collision course with the latter option. And so that sense of fearing, foreboding is simply that where we are, monetary policy now will lead to, I think, quite a rapid decline in economic growth, arguably a global recession. And if that comes to bear, I think we'll be back into the analog which has haunted the global economy since 2008, which is one of tepid economic growth and an inflation which actually may fall stubbornly below the 2% target of central banks. Risk asset prices higher higher into the mounting evidence of economic weakness. And actually another similarity would be the central banks expressing more fear for inflation and the control of inflation than a drop in economic activity. That would be the similarity with then. Where it differs, of course, has been in the employment statistics. If we were to compare where we are today, beginning of August, with August 2008, you'd pretty much come off the run of about 9 or 10 months of very weak labor markets, of a contraction in labor markets. That clearly is not the case. And so we then have to talk about why that's not the case. That would be a difference from last time. And so 2008 and the storm that beset the American economy and the financial community was that there had been 3-4 years of rapid mortgage growth. And that debt had been accumulated on what we call a teaser rate. You know, it was pay very low and hope to flip the mortgage, flip the housing asset before the reset. But of course, life is never goes to plan. And we did get the reset. And so you went from people committing to mortgages and paying as little as 1 or 2%, suddenly finding themselves with mortgages resetting to 5, to levels where they could not afford it. And that's where you got the crunch. Today, that's not the case in America. The pandemic and the lows that we saw in 10-year and 30-year US treasuries allowed for the household sector in America to refinance into 30-year rates. So the majority of US mortgages today are kind of sitting with a mortgage rate, let's say, of no higher than 3. And so you've not had that pain. My only point to that is that so where the household sector has been saved, the risk has been passed on to capital markets. And that risk is that banks and other financial intermediaries who borrow short and lend long, they now have a back catalogue of assets which have been set at the wrong level. And we famously or infamously saw that in the demise of the 3 regional banks, and probably in Credit Suisse, but particular to the 3 US regional banks. When their solvency was called into question, when they lost deposits, they had to realize losses on their government treasury books, and that made them insolvent. The question, and the Fed would like us to answer that was specific to those 3 particular institutions. I'm not as sanguine as the Fed with regard to that, but strengthening their case is, well, that was in March, and then we had April, May, June, July, and nothing. So maybe it was confined. Time shall tell, but I am somewhat cynical that is the case. And validating my skepticism would be the tightening. I was going to say profound. There's been a severe tightening in credit demands by intermediaries. They're kind of closing up shop. You know, here I am 1 month before hurricane season, and in a few weeks' time, we will be battening down the hatches. And that would seem to be an appropriate metaphor for how the US banking sector is presently set up. It is, what did I say? The banking sector is fearing the worst. And therefore, economies need credit. Credit is like an oxygen, which keeps the body economic alive. Once you start withdrawing that, again, you start to see problems. But so far, those problems seem more profound outside America. And so the question is, over the course of the next 6 months, will we see more clear and present danger within the continent of North America?
Can you say that they've maybe sucked the credit out of, you said the private sector, but they've sort of injected it into maybe, fiscal stimulus and the public? Or do you think maybe that's why the economy has been a lot stronger than maybe people expected, because it has been offset in that regard?
Number one reason has been the transfer of the interest rate risk from the household sector to the financial sector. It's number one. Number two, to your point, the economy is still feeling the positive impact from the profoundly large fiscal stimulus. And of course, that's very acute. We're seeing that in investment data for the building of new manufacturing facilities, onshoring, if you will. But only this week, the much vaunted airline sector, we all take flights just now and they're damn busy and they're damn expensive. Well, JetBlue just announced a profit warning. It's not even a polemic. It's I find this period just now is better spent in a sunny, warm climate. The cast is die. The die is cast. Again, let's talk factually. We've had the most rapid, largest increase in Federal Reserve rates. Rates are already positive, like real, to the tune of like almost 2%. And that represents tightening. The market's fascination is we're going to have a soft landing. Market likes soft landings. Market always trades like that until the evidence suggests that's not the case, and then the market very rapidly changes prices again. So, you make your bed, you lie in it, and we'll see. I'm cool with where we are.
Yeah, before we started recording, you said that it's sort of like we're in the waiting room. We're sort of waiting to see what's going to happen.
We sure are. I mean, we are observing not heavenly bodies, but we're observing, if you will, these large, profoundly large oil tankers. Let's speak metaphorically again, and they turn, but they turn very, 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 very slowly, mostly during the night when we're asleep. You put, I ran global macro accounts for over 15 years. And we typically look to underwrite into a 2-year window. When I say 2 years, I'm saying I expect my profits to arrive within the next 2 years. I don't put a trade on and think I'm going to make money like now. I build into it. I'm small. I'm watching things. With confirmation, I'm adding things. My narrative would clearly favor risk-free US government treasuries. The 10 years yielding 4, the 2 years yielding, higher. There's an inversion. I've been buying options just now because the market is undecided. When I have an idea, I call a friend, the market. I'm like, and we look at the trend. If the trend is positive, then I feel it gives endorsement and legitimacy to the prejudice which has formed in my mind. That is not the case presently with US government securities. The only thing positively one could say is they've meandered sideways. They're essentially the same prices they were last September, October. So, if you will, there's been lots of positive economic surprises in the US. And yet those bond prices have remained at the same level. So since about March of this year, I've been accumulating a call option, not too far out of the money, but expiring at the beginning of the year 2025. And one doesn't like just being outright long a call option. We call it there's bad extrinsic value in options. Option writers are very, very rich. It's a casino. People feel compelled to buy calls and puts. Every call and put that you buy is overpriced. You know, option trading is like shopping in Gucci or LVMH. You know, you're coming out with an expensive product, and so I'm very conscious of that. As I've spent about just over 100,000 notional dollars on these 100 strike price on the TLT. The TLT is a US ETF, which gives you like 17-year plus duration or maturity, 17-year plus maturities on a basket of treasuries. And recently I've been selling out of the money calls like 103s. And then more recently, I've been selling puts again. So if 100 is the central tendency, I'm selling like 102s, 103 calls. And more increasingly now, I'm selling a lot of 98 puts. And that's kind of lessening my absolute dollar down on that. And I'm really like, and the puts that I'm selling are short-term expiry, you know, they're 45 days on average. Because again, to the notion of it being slow, the Fed won't meet again for another 2 months. So unless there is some dramatic financial casualty, we will resume this interest rate thing in September. And the Fed will probably say, yeah, we're going to hold. Maybe they raise again. So that would be, again, I don't really care. You know, that's, you know, I think they're wrong. They'll keep being wrong until the evidence disproves them. But it gives me an opportunity to sell like short term and cheapen up the asymmetry of the call options. What's the worst that could happen? You know, the TLTs, which are trading, I don't know, 100 or 99, are they going to trade 96, 95, 94? With those puts that I've sold, I mean, I would take delivery. I would be delighted. I would be absolutely ecstatic with the opportunity to actually come in and buy a couple $1 million of treasuries at those prices. So, you know, you rehearse your strategy. It's the future. There are multiple scenarios, and I have my little scenarios, and I know what I'll do. And presently just boring.
Is that always important when you put a position, is having those multiple scenarios and multiple situations where you can take actions depending on what you're seeing?
I mean, more than I was looking at the model today, and I'm actually carrying positively. Yeah, I've got a lot of short dated, and they're expiring worthless, and I'm selling them, so I'm capturing that premium. So I'm actually, I've got the convexity of a fixed income trade, which is a growth shock, where the price could really take off. I've got that. That, if you will, that's an insurance policy, and the way I've constructed it, I'm receiving income as I wait. So pretty damn cool. But you know, maybe I'm wrong. Maybe Goldman Sachs et al. Maybe it's a soft landing. I don't see it. You know.
Yeah, it's really interesting to hear your strategy and how you sort of put that together. And as you're saying, it's the time frame of understanding that the original position is 2 years. You're looking to make money in that period, but then you're also doing these smaller, convexity trades, as you're saying there.
Yeah. God, I've got so many mosquitoes.
The exotic nature of things. So I'd be interested to hear your opinion, because I guess if we look at 2008, really what you could say, there was massive leverage, and Lehman's and these other big banks, the Fed and other institutions didn't come in quick enough. There was this uncertainty and concern that all these institutions were going to collapse because of the higher leverage there. And we've seen that central banks are a lot more eager, I guess, to jump in quicker and to actually bail out these financial institutions or these industries overall. So we saw in the UK, the pension almost blow up that we saw in the Bank of England, while while they were selling bonds or while they were tightening, they also went in and sort of saved that part of the market. We've also seen with SVB and the collapses that occurred there, that the Fed came in and sort of started that they bought the bonds off the banks at sort of face value, even though they were worth a lot less. So do you think there's the risk that maybe the Fed will just cut, or the central banks will come in a lot quicker, and that we might not maybe see that downside, or do you think maybe it will just quicken the time frame of the movements? What are your thoughts on their actions there, and what could happen?
What are you talking about?
Did that make any sense or no?
No, I mean,
No.
let me remind you, February of 2008, the Fed brokered a deal for JP Morgan to buy Bear Stearns, but Bear Stearns equity went to zero. Okay. Several months later, the equity of Wachovia Bank, Golden West Financial, Washington Mutual, Countrywide Financial, they all went to zero. At the same time, the Fed was accommodating. This time around, you had 3 regional banks, their equities went to zero, but the Fed stepped in and was a lender of last resort, kept them going. It had to be the lender of last resort because the major money center banks refused to securitize their loan portfolios, to give them overnight capital. So the Fed stepped in. I mean, it's the same analog, what the Fed, it's the same analog, right? So the Fed was going, it's the same and it's not, forgive me. We might have to jump between jurisdictions. So I just described the US, and I guess the Fed was conscious of those very large financial bankruptcies, and it spent all of 2008 cutting interest rates, and it was very rapid in January. I think they took 3 cuts in a week. Outside America, central banks were hiking interest rates. The ECB hiked interest rates. Bank of England, had saw the demise of Northern Trust in as early as August of 2007. If you fast forward to August of 2008, the Bank of England came very close to raising interest rates. And remember that the majority of the loan growth in that period, 2004 to 2007, in terms of funding US mortgages, was coming from overseas banks. In terms of the Fed bailing out financial institutions in 2008, 2009, the largest recipients were overseas banks. Yet the overseas banks, their regulators, again, their concern was inflation. So again, that was 2007, 2008. The difference this time is the Fed has seen the demise of 3 significant financial institutions, and it's hiked interest rates over that period. Now, it can kind of get away with that because, again, the household sector is not feeling the duress and the tightness. Its mortgages are not resetting. It's not in impacting on its income. So it can get away with that longer. But I just read something today. The lending rate for taking on a new car is at a record all-time high, 7.2. If it's a used car, it's 10%. And if you actually secure a new mortgage, I think you're paying somewhere between 7 and 7.5%. And if you work the maths, if you want a car and you want like an average house and you're on the average income, it's swallowing up 72% of your income. I hope I got that figure right. So 72% of your income is being swallowed up by the interest payments on your car and on your house. And then, heaven forbid, but health insurance, if you got it, I mean, that's going to swallow up a hell of a lot more. And you got to find money to feed yourself and travel. And that's the tightness. So there's a trade-off with where we are in America just now, which is that the economy has been more robust. But presently, the household sector cannot afford to move house. If you move house, you need a new mortgage, and so you reset from between 2 and 3 to between 7 and 7.5%. So we're kind of in a limbo just now. And then back to your thing about the fiscal stimulus, there had been certainly a very positive boost to the personal and corporate private sector in America. They effectively received stimulus checks and bailout funds, and now speculation of that running down. There are some Fed papers that suggest that's already been pretty much fully depleted. So these are all arguments that suggest that there is a slowdown coming, but the Federal Reserve is somewhat boxed in. It is believed that what I believe was the transitory supply shock in pricing. But the Fed has conjured up this notion that it's a 1970s inflation slayer, that it's Paul Volcker, and the great enemy, the great dummy was Arthur Burns, who had the ignominy of being the central bank governor who raised rates mid-70s and then cut them only to see inflation shoot back up. I don't think any analogy for the 1970s is relevant at all. I think poor Arthur Burns was taken down just by context. I think he got unlucky by being the governor then. I think he'd be a hero today. That's my presumption.
Yeah, that's a good point. And I think I heard you say in your recent interview that even if the Fed didn't raise interest rates recently, that inflation would have still done the same, or even if they raised it earlier, it still would have done sort of the same increase because of the supply shock and then sort of come down as well.
I was quoting the Bank of England governor who stepped down a few weeks ago. And, like some people say, yeah, they're just, they're talking their own book. What is she? I always forget her name. So Sylvania Danlero. But, she said, we have these large factor models, and we can go back and say we had 2020 vision. We could see in advance that there was that we had solved for the virus, that we had a solution. Within 6 months, the economy would be coming out of that downturn. You could see with perfect vision that Russia was going to invade Ukraine, that natural gas prices were going to go up 20-fold. You could see that would the effect that would have. Whatever, you'd have been raising interest rates to 5% as early as like the end of 2021, and maybe you'd have taken 2 percentage points off the flare. We got to like 10.8% in UK price inflation. That model would have it flaring out at 8.8. The difference would be, the expectation for UK GDP growth next year would be like -3%, which is a big downturn. So it's not obvious what monetary policy can do. And again, remember, so we talked about US households transferred the risk onto the financial sector with their mortgages. Now they've transferred it for 30 years. But Fed hiking does nothing in terms of being restrictive. It just prevents you from moving house. And so that is incrementally, that takes away from the rate of future positive GDP growth, because moving house, the fees, you buy a new washing machine, a new TV, I don't know. That we're all stuck just now. That's not happening. In the UK, you can transfer that risk for 2 years. Canada, Australia, it's the same. And so that, again, if we use my silly language or fear and foreboding and stuff, the fear is greatest in the overseas territories. My fear is the UK is really, the monetary policy is now going to be restrictive now, because now it's repricing into mortgage loans every quarter, and mortgage loans are resetting into a death zone. House prices are falling. Landlords, people who've been formerly renting, they've raised their rent, and now people are like, I can't afford to stay there. And so they're seeking to sell their property. There's a glut of property wanting to come onto the market. So here we are 2 years after the inflation impulse of the scarcity, being in the pandemic, encouraging people to spend, having to ship it, bottlenecks and ports. That's all gone. And monetary policy was largely redundant because of the role of the financial sector intermediating rates between the capital market and the household sector. So it didn't really come to fruition. So again, perfect vision. You still get a flare. It's maybe less extreme, but it's a flare. And the problem is you're just about to hit the point now where monetary policy is very effective. It's going to be very, very effective. It's really, really going to tighten in Australia, Canada, UK. I think we were discussing that the Australians decided to pass on any further rate increase for now. I think that speaks to it. Bank of England is soon to report. Does it go for 25? I mean, mounting evidence. Bank of England. Personal opinion, policy rates are too high. Okay, they should be. If I was in charge, I'd be cutting them. But they can't. They're boxed in. Their credibility, all of the suits, all of the kind of the wise heads that are anything but wise, and they speak on financial TV and they get columns in financial newspapers. They would go crazy. Like the Fed is going to be, inflation is going to be sticky. You're going to get a soft landing. The Fed has to keep rates elevated. Been there, seen it, know what happens.
Down it goes, down, down, down. Is what we're seeing and what we think will continue with inflation at least. So yeah, it's really interesting to hear your thoughts. I'd be interested to hear. You've mentioned bonds and how you've got a position there. I'd be interested and I've heard you say that you really like these sort of pulsating, strong uptrends, and that's really what you always look for when you put that position on. And I think, as you said there, that it's a bit of a slow burn. You sort of slowly start building and building as you get further confirmation of these strong uptrends. Is there anything else that you're sort of keeping an eye on, or that you're watching that you think that you're interested in, or you think that might maybe be going in that direction?
Well, I mean, evidently, the secret to investing is to kind of, as much as it's tolerable to invest without prejudice, and to be exposed to rising asset prices. Equities, like people listening and be like, who is this bozo? The Nasdaq's up 40%. Like, we're getting a slow landing, baby, soft landing. But so I try and invest. I try and be a little bit diversified at all times. I try and speak quadratically in terms of like four risk buckets that I try and have a permanent representation, and quarterly I try and assign weightings to that. So if we think about notional $1 million portfolio for private wealth portfolio, in the equities, I've been arguing since March I'd have had about $200,000 in Nasdaq, or in the 7 stocks which are going crazy to the upside. Again, without prejudice, their valuation is high, is at challenging levels that probably subtracts from future returns, but they're going up. Okay. Today, I'd be trying to take that back from, if I'd said $200,000. Yeah. I'd be maybe 150 now. But it's not a million, it's like 15 to 20%. And even then I'd be kind of looking at options, looking at the spider, it's the ETF. I mention these ETFs because, for the American folk tuning in, you get these tax saving accounts. You can't buy options on listed futures. That would be a taxable event, but you can buy options on equities. So ETFs, which have their underlying asset in a macro category, are kind of interesting. Just now there, I mean, I'd be putting on kind of bearish option strategies, overlays on US capital markets. But that's what I am. Okay. The second risk bucket would be the treasuries. I can't buy futures just now. I can't buy anything outright because they're not pulsating. They're not trending positively. Okay, so I spent the best part of like $100,000 on options. So I could lose all of that money. Boom, I could lose 10% of my portfolio. I won't lose it today or tomorrow or next week or next month. But if we were transposed to this situation, if we were having this conversation and it was August of 24, I mean, my options would be worth, if we were still at these prevailing prices and I was still arguing that we were really so close to getting a recession, I'd be wrong, but the market would be telling me the option premium would be disappearing. The theta decay, the cost of time passing every day would be severe. It's very severe just now in the options that I'm selling, because I'm selling 45 days and that market's doing nothing. So the theta, they're just collapsing. And if you will, I'm short that. So. But what did we say? We said, I think I'd have about $150,000 in NASDAQ, let's say. I've spent $100,000 on option premium in the treasury market. I'm now at a situation where I'm getting positive carry on that. Modest, but positive. Okay. The third risk asset would be real assets. There's always a fear of fiat currencies and what have you. There's like over $100 trillion of risk assets you could choose. You could buy oil futures, you could buy property, private equity, gold, Bitcoin, etc. And there I'd have 5% in gold futures. Only 5, but I mean, I'd have a permanent presence because for the last 12 years, gold has been on a price barrier of about 2,000, 2,100. Long barriers, long in length, 12, 15 years. My presumption is that when they are breached, then the people who are much smarter than me have reached a very, very positive assessment of what happens next. And I can join them. So I got 5% because it's been 12 years. Maybe it'll be another 12 years. I don't know. But I'm kind of set up. And if it does breach the barrier, I put another 5 and then another 5. I'd cascade upwards into it. But gold is what is gold? Is $13 trillion in terms of worth. That's a big number. US economy is 25 trillion. So gold is valued at like 50% of the output of the US economy annually. If gold tripled, it would be valued more than all US equities. Really hard. Not saying impossible, but really hard. So my probability assessment is coming down hard on that. And so that takes me into Bitcoin. Bitcoin's, again, it's a bit like treasuries, not really doing much. Can't really buy options on it. But Bitcoin's something where, what is it, 29,000? If it was 25,000, I'd want to buy more. If it was 20,000, I'd want to buy more. If it was 15,000, I'd want to buy more. If it was 10,000, I'd want to buy a lot more. Why? Because presently at 29,000, Bitcoin, not crypto. Crypto I'm not interested in. Bitcoin is $0.5 trillion. It is tiny. And you can see the big casino houses, the BlackRocks, the Fidelities and stuff. They need customers. They need a new slot machine. Bitcoin's an amazing slot machine. So there's moves afoot to launch ETFs, to get the punters putting money in the slot machine. So like Bitcoin could double, triple. Yeah, I said to you, if gold tripled, it's really challenging. If Bitcoin triples, it's $1.5 trillion. It's about the same size as Facebook. It's not a big ask. So, okay, I've got 200,000 in Bitcoin. I've got 50,000 in gold. I've got $100,000 in my option premium for options expiring in the treasury market beginning of 2025. I've got 150,000. I'm long NASDAQ futures. I'm now beginning to write overlays because I think the market has gone too far. And then you come into my final bucket, which is cash. Wow, I've got 5.5% positive carry. So then let's rework it again. what if I bought NASDAQ futures? Okay. Almost no cash has left my account. You know, if I bought Bitcoin futures and gold futures, I've not really spent, I've still got all the cash. The cash is the collateral to those assets. The only thing I've spent is about $100,000 on option premium. So, which is to say, I've got about 850, 900,000 in cash, earning at least 5.5. Maybe I put some into muni bonds. I think they're about 7.5%. Okay. And so again, life is, I mean, look, life is sweet, you know, and so I can sit around and go, yeah, I think Fed fund rates are going to create a recession. And people say, well, we should have seen. I'm like, no, because you know, the household sector was protected by having, you know, locked in lower rates. But the household sector in the UK and elsewhere is busted now, and the US sector just is frozen. It can't move. And at some point, I would imagine that residential US home prices will have to come down. Presumption. Anyway, I'm kind of cool. I'm kind of that portfolio is outperforming just about all macro funds year to date. And I'm ready if there's change, right? So if we get another financial casualty, if we start to see unambiguously weak US data, okay, the equities I think will come under pressure. I'll make money on my overlay. I'll probably look to reduce my exposure to equities. And that is scenario, my TLT's trading at 100, maybe they're trading at 110. And I'm like, you know what? I'm going to take some of, it's great that my 2-year cash, whatever, is my near-term cash is over 5%, but I can't compound in 20 years at that. And so I'm going to say, you know what? I'm going to come in, I'm going to grab 4% at a rate that I can compound for the next 17 years. I've got the cash, just going to buy it outright. And like Bitcoin, I have a 20% of my portfolio. And I would be happy to take that up to like 35% of my portfolio if prices were weak. So, you know, again, the future will be what the future shall be. We're simply conceiving of scenarios, and then we're asking ourselves, how would that affect our P&L, and what would we do? What you don't want is to have to like puke, like, oh bugger, like, what's the worst thing if I'm wrong? I mean, where am I wrong? So equities would have to fall, treasuries would have to fall, Bitcoin would have to fall, and cash rates would have to drop really rapidly. How much would I lose? Not really that much.
Yeah, it's amazing to hear you explain it, and I guess the thinking behind it. And thanks for sharing that. I know it's not something that a lot of people would share, sort of their positioning and I guess the whole portfolio, and it makes a lot of sense in my opinion. So, Hugh, thanks so much for coming on the podcast. I really appreciate it. I guess my last question is, what is one message you'd like people to take away from our conversation?
I mean, I'm bored talking about it. Just I've been talking, you know, I've been So I've been prepping and preparing and putting this trade together and trying to disseminate my understanding, my knowledge of it for the last 5 months. And to those unaccustomed to investing in macro, they're like, yeah, they're like my children. When my children were younger, I remember we planted something in the garden, and you know, every day you got a little kiddie plant, you know, the water spout. You put water on it, and like it's going to grow into an amazing, beautiful plant. And after 3 days, nothing happens. The kid's like, nah, you're like you're making it up. You're wrong, daddy. And people are like that with macro, like, oh, you got no credit, but like, where's your P&L? Nothing's happened. You've been saying this. It's like, shh. Macro is slow, baby. It's slow, and then boom, it's bloody fast. So, you know, and the other message would be complexity is a bad thing. Beware of complexity. What I've described, everything can be done with a personal portfolio. I'm not using a Bloomberg screen. You know, we have the www. I don't favor Google. I don't like it sucking my mind of all of everything I write in a Gmail. I don't do Gmail and I don't do Google. But you know, there are other web browsers, and I can go, hey, you know, what is the future? You know, like What is an ETF for buying treasuries? Can I buy that in the UK? What is the code? You know, what is the ticker, the Twitter handle? Twitter, I mean, what do we call it now? It's not Twitter, is it X?
Yeah.
Xter? I mean, it's so dumb, silly, but you know, let's call it Twitter. What's the Twitter handle of the asset capitalist? Hey, it's Henry_Hugh, you know. How can I keep informed? You know, subscribe to Patreon. Patreon, you can actually sit down and I'll mentor you. You know, we'll take 45, 60 minutes. We'll look at your portfolio. We'll discuss it. I can't give financial advice, but I can tell you how, you know, how I see things. So, you know, life's sweet. Don't let them get you down. But if you're in the UK, Australia, Canada, wow, I mean, you don't need me to tell you, it's getting tough out there, you know. So if you're just hoping things are going to get better, they'll get worse. And if there are actions you can do and you're just putting it off, do them today. You know, don't live in hope, live prepared, and then the contingencies are all positive.
Great messages. I know, you know, you can go through Patreon, or you can even come to the island and meet you in person. I know you have a summit coming up, I think, if I'm not mistaken.
Oh yeah. Starting on the 21st of August. I'm going to have Jeff Snyder. I'm going to have I'm going to have Brent Anderson, Santiago, doing his milkshake. George Gammon, you know, like going to have it's going to be fun, like the most beautiful dope house. Chefs, we're going to have a party, and we're going to discuss things. And it's, you know, it's not for macro hedge funds. It's for, you know, business leaders, you know, people with corporations just trying to cut through the silly code and just the dullness, which is 24-hour financial TV.
Can't think of anything better. So Hugh, thanks again for your time. And yeah, you've mentioned Twitter, you mentioned your hands, or you mentioned the summit. Is there anything else? Patreon, anything else, or is that it? Is that where people can find your work? Asset Capitalists
You know,
podcast.
let's just keep an eye on the, you know, again, just remember, like when you look at these prices, they evolve slowly. You know, maybe another time. I'm sure when we catch up again, we haven't given it true justice. We haven't mentioned it at all, but there are little earthquakes. Can't really say earthquakes because it's Japan and they could have a tsunami and stuff. But you know, they had an intervention in how their central bank controls things. The market's got their narrative. My narrative is somewhat different. But regardless, the price action is making me think, wow, I mean, the yen could prove very weak. I mean, the yen can do anything. You know, the future is unbounded. I look at chart formations and I see how markets react when there are policy shifts and changes, and like just bells ringing, like dollar yen really could, like to my mind, it looked as if dollar yen had reset. If you think of a bell curve distribution, so bimodal distribution, which is say you know, the probability, an even spread of probabilities. And it kind of looks as though, I mean, I'm making this up, but like it had forever it traded at 100, and if we take the axis and we put it this way, so now we've got a bell curve. I can't even where my fingers going. You know the bell curve. Previously the central tendency would be like 100, and the wings would be 120 to 80. 80 being very rare. We only hit 80 when we had the tsunami and the like. But you know, we were commonly trading above 115, and something twisted the axis or whatever, and now I feel it's 150, and like two standard deviation events take it to kind of from 150 down into like maybe 130, but on the other side it takes you into kind of, you know, 170, 175, and I just feel like actually there are so many barriers that if you were to slide into anything above 155, the trend could accelerate and we'd be looking at 200. So we'd have to imagine a world where dollar yen traded at 200. But I think that's what we might discuss the next time.
I think if I'm not mistaken, the yen was at over 200 in 87 when the economy crashed.
Did the economy crash? So in 87, the stock market crashed dramatically in one day. George Soros had all of his money betting that it would be felt most severely in Japan. It didn't. And Japanese stocks went on from October 87 to record extraordinary highs 2 years later at the end of 89. And then they've never been surpassed. Here we are, 40 years later? 40 years, can I say, but 30 years later. That the portents of gloom from the stock market, the S&P dropping 20% in a day, never bore fruit until really the quite severe recession of 1991. And 1991 had been the kind of near bankruptcy of the savings and loan smaller bank franchises. It's complicated. It's complicated, but something's going down. Something's going down. They're messing with the rates. We all know that there's an abundance of debt. That again, in order to grow this economy, you have to accumulate more debt, and you can be morally outraged about it. The only thing you can say with certainty is that when you replace equity with debt, then you're making the system more volatile, and so one should be expecting more market disruptive events where you get plus 20% declines in the S&P. They should happen more frequently. The economy should be subject to reversals and recession more frequently because of the balance towards more and more debt. And then to compound that situation was volatile but tolerable, except today the monetary authorities globally have raised the cost of carry on that to levels which are like just in the number of years that were like 22-year highs in Bank of England rates et al. Okay, in real terms, they're like approaching 2%. Let's see what happens.
Great place to leave it. And yeah, as you said, I feel like we'll have to say that for next time to Japan because we talk about it for hours. But yeah, Hugh, thanks so much for your time.
Cool.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.